The economy has held up well. I think a lot of it's government induced, but be that as it may, the economy has held up well. It looks like current quarter GDP could be over 3%. We've had inflation way above target. The Powell Supercore is running over 4%. It seems to me that the Fed is stoking potentially some excessive risk-taking in the market. So I would prefer that they had not cut in November. I don't see the justification for December. Having said that, they will wind up cutting.
Okay, so if they do deliver it, do you think that's sowing the seeds for a reacceleration in inflation just when they were getting close to that 2% target?
It's possible, because the problem is the Fed had, they raised rates aggressively because they were way too slow in hiking. We had excessive demand side stimulus. And when they cut in September, it was based on the fact the labor market at that point looked really, really soft. To me, the labor market isn't great, but it's improved. And what's happened is financial conditions now have eased massively. So the problem with the Fed easing further is they may just further stoke an easing of financial conditions. It's not just the booming equity market, but it's also rising home prices. It's generational lows in credit spreads. So those are the concerns that I have. The Fed could just make the situation worse by effectively adding, the proverbial more fuel to the fire.
So you think the booming equity market is more to do with expectations around monetary policy than, say, expectations of Donald Trump taking office in January and everything that will bring?
No, I don't believe that to be the case. I think the Fed has to be much more careful about the money supply and credit creation. We've seen M2 growth accelerate in the last 3 months to almost a 6% rate. The small caps and the financials in certain sectors are very enthusiastic about President-elect Trump coming back. We see that in a small business survey where you've just seen massive, basically vertical jumps in things like good time to expand and expectations the economy improves. No, I just think this is a part of a bigger narrative where the Fed just has not done a very good job signaling its intentions and has been wrong-footed many times on inflation. And I'm just worried in the short term by the Fed easing more and potentially getting more money in credit creation, they make a potentially sticky inflation problem worse.
Well, Joe, you and I have had several conversations about the future of inflation and the role, if anything, tariffs could play in that. I know you see higher tariffs as effectively bringing a one-time price increase. They should be viewed holistically with everything else economically the president-elect would like to pursue. But I guess my question for you is, how do you think the Fed views it? If it is a price increase they ultimately see, what is the reaction function for monetary policy?
I'm happy you raised that question, because I think I'm very bullish on growth next year. I think inflation will moderate because I see President-elect Trump's policies as expanding the supply side of the economy. Its potential, productivity, basically, its ability to produce the things that we want. However, I think the Fed has taken a much more demand-side Keynesian approach. They view the inflation process as not really a money and credit phenomenon, but rather where the unemployment is relative to NAIRU or where the output gap is. So that my fear is that they're going to look at a tariff increase as being inflationary when it's not, and when they should maybe be easing next year because productive output increases, instead they hold pat, and that would obviously set in motion a negative reaction in markets and the broader economy.
Well, and when we consider the global economy, there's also the consideration on not just what tariffs mean for higher prices in the U.S. potentially, but also if we are seeing higher tariffs and it results in a, if not outright decoupling, a lessening of the trade relationship between the U.S. and China, the world's two largest economies, what the wider economic ramifications of that could be, not just here at home.
Yeah, I'm not worried about that, because I think you've already seen when President-elect Trump talked about 25% tariffs on Canada and Mexico. There were quickly talks where both respective leaders either went to see President Trump in person or had conversations shortly thereafter, as reported in the news. So I think, again, this is a negotiation. Tariffs will be a very powerful and important tool that will be used. I just think it's incorrect to look at them as being inflationary, which I think some on the Fed will look at, and I think that would be a monetary policy error, especially if we're cutting regulations and oil prices and energy, more broadly speaking, falls. That's where you can get some real improvement on the pricing side, because you got these second and third order effects when energy prices fall, the inverse of what we had when inflation surged back in 21 and 22 when oil prices were higher. You'll get the opposite.
Joe, finally, I want to ask you about something else in the news today, which is that we got the text last night of a mammoth government funding continuing resolution that there's been a lot of pushback from Elon Musk. Vivek Ramaswamy don't like this. Now the president-elect's son, Donald Trump Jr., says the American people didn't vote for this. They voted for the opposite. They voted for transparency. This cannot pass. Just quickly, Joe, if we were to somehow stumble into a shutdown here before the holidays, do you expect it would have a real economic impact?
No, I love the fact that we're trying to get rid of this pork barrel legislation, and we're actually trying to do something productive that's a bipartisan issue. I don't look for the government to shut down. I think ultimately the government will be open around the holidays, and I'm hopeful that whatever we get on the budget resolution, it'll be basically pushed to next year where a more comprehensive, better formed bill than probably what's out there right now, what it comes out as. In other words, I like what's happening. I think it's important. We have to have this discussion.
And we still have a minute left here, Joe. So if you could ask the Fed chair, Jerome Powell, one question in the press conference today, assuming that what they do deliver is a 25 basis point rate cut, what would it be?
Well, I would like to get some more information on where the Fed thinks it's, neutral is and how they compare that to where financial conditions are, because monetary policy has not tightened effectively for most of the economy. We've seen basically the cost of capital fall quite dramatically because of the rise in equity prices and very tight credit conditions. So why are you easing policy when you could just wait? And why are we so worried about what investors who are betting on in the Fed funds futures market, why are we so worried about disappointing those expectations? Wouldn't it be better if policy was perhaps a little bit more two-way on the risk? Why is it that investors can't lose money sometimes, or why can't they be disappointed on where monetary policy wants to go? I don't understand that. I think the Fed has done a really terrible job of setting policy in a way that's led to major misallocations of capital because they believe that they can't let Wall Street down. And I think that's ultimately very unproductive, and I worry that if the Fed does cut today, as they likely will, you actually might get a more negative reaction ultimately in the bond market than had they just not cut and let the market kind of evolve as I think it will in a positive fashion. But I first want to see inflation go lower, and the Fed should do that.